talking to investors about how they may go about implementing an investment strategy that works for them, most people are knowingly or unknowingly looking for a strategy that A, beats the benchmark, B, doesn't lose money, and C, works all the time, which is quite literally impossible. Anyone selling you an investment with all three is likely either ignorant or lying to you. And trend following is no exception. In fact, it's potentially one of the most painful strategies one can dare to implement. And that's because trend can deviate from the benchmark a lot, which is great when it's a positive deviation, but can be devastating if the tracking error is to the negative side. Having said that, trend following can be a great exposure to have in order to attempt to preserve capital in the presence of a big drawdown. And because of that, it can also be a great complement to long-only equities. So, should investors even bother with trend following, or is it worth the pain? Trend following is a strategy whereby investors buy or hold an investment if it's going up and begin selling if it starts going down. Now, this has to be done using some sort of rules that look at price action history for investors to remain objective and not let their own views get in the way of a trend following program. But does this system work? In the 2013 paper, Absolute Momentum, a simple rule-based strategy and universal trend following overlay, Gary Antonacci applies absolute momentum or trend following to a basket of assets from 1974 to 2012. He finds that for all the assets tested, the Sharpe ratio was higher for trend following, the maximum drawdown was shallower for trend following, and that in all but 3 of the baskets, trend following actually beat buy and hold. Similar studies find similar conclusions. Trend following has historically given you similar returns to buy and hold with a higher Sharpe ratio and lower drawdown. But like anything in investing, one must ask the question, why does this thing work? And why hasn't it been arbitraged away? And in the case of trend following, the answer is pretty evident. This is a painful strategy to implement. Here's Alpha Architect CEO and CIO Wes Gray explaining why trend following can be a terrible strategy if one has the wrong expectations.
When one looks at a back test of any trend followed strategy, it's going to be amazing. You're going to capture most of the upside, if not all of the upside, but with half the drawdown. Who wouldn't want this, right? However, in the short run, when one looks at actually the number of what one calls whipsaws, which is a situation in trend following where the trend looks bad, you get out, but then the trend pops right back and you have to buy in at a higher price, which is a terrible outcome. It turns out that happens anywhere from 70 to 90% of the time when you look across broad markets. And anytime you have to do a strategy that loses 7 out of 10 or 9 out of 10, it's obviously not going to be a pleasant experience in the short run windows, even though maybe over the long haul, it delivers exactly what you wanted.
While zooming out on a chart, trend following can look amazing, but when zooming in, one will quickly realize that periods of heavy underperformance are not only commonplace, but to be expected. One must have the right idea about trend following, what it is and what it isn't, in order to be able to stick to the program. And trend, in my opinion, is positional, not predictive. What I mean by that is not that trend following isn't likely to protect you if a big enough drawdown comes at a slow enough pace, but that it is worse than a coin flip in being able to identify any given signal trigger as a true signal. That means that anytime a signal gets triggered, an investor may end up selling the asset just for it to roar back up. And the investor will likely have to buy back, this time at a higher price, likely realizing a small loss. And this is likely to happen 70 to 90% of the time. A trend follower will then likely face loss after loss after loss, and this can be psychologically damaging given a long enough time frame. But Jose, if most of the time one loses, then how can trend keep up with buy and hold? Well, though trend is not necessarily predictive, it is positional. It gets you ready for the worst. Living in Florida, I had the chance to face a couple of hurricanes, and as any Floridian can attest, the number one advice given to you before a storm comes your way is prepare for the worst and hope for the best. And trend following is kind of like preparing for a hurricane. Maybe the storm deviates from its path, or maybe it loses its strength. Maybe you didn't need to put up your shutters and buy that expensive generator, and all of the time and money you spent preparing was for naught. But maybe, just maybe, you'll be glad you prepared when you did, because you stand to lose a lot given the wrong circumstances. So Trend really positions you for the worst case scenario, and when those scenarios do show up and the investor is prepared, he or she can gain back all the losses experienced with the small whipsaws. So Trend is about experiencing constant small losses and huge once in a blue moon wins. And because of this, trend following can actually be a great counterpart to long-only equity portfolios. That is because equities tend to show the opposite payoff structure to trend. Stocks tend to have modest wins most of the time, but can have gut-wrenching declines every now and then. In other words, stocks tend to take the escalator up and the elevator down, and trend overlays tend to take the escalator down and the elevator up. Following this logic, one of the simplest ways to utilize trend would be to target highly diversifying assets to equity, such as bonds and commodities, to complement a long-only stock exposure. This is likely to be a way easier way to implement trend, as it's not likely to present you with a large tracking error associated with a portfolio-wide trend program. And additionally, one has the option to control how much exposure one wants, so one can capture a lot of the benefits of trend while still being able to truly diversify a portfolio. Now, for trend following junkies who can eat tracking error for breakfast, lunch, and dinner, one can consider utilizing trend on a stock portfolio to reduce risk based on trend dynamics. And this can lead to gut-wrenching deviations from the benchmark over the short term, while also providing the benefits of trend over the long term. So, if you decide to implement any sort of trend program, no matter how big or small, here are a couple of good things to keep in mind. 1. Whipsaws are part of the process. There may not be anything necessarily wrong with your investment program. If a signal kicks you out and forces you to buy higher, that's just what you should expect. 2, you can be wrong for long periods of time. In fact, with trend, one must measure time in decades, not years. 3, welcome to the club. You know, something as painful as trend can be easily dismissed by both practitioners and academics, and yet there's a small cohort of investors who swear by this strategy, me being one of them. So, if you decide to implement some sort of trend exposure in your portfolio, no matter how big or small, I welcome you to the Trend Club. That is it for today. Thank you so much for watching. If you enjoyed this video, make sure to like and subscribe, and more importantly, share this video with a friend. Also, make sure to head to alphaarchitect.com/subscribe, and there, make sure to subscribe to the blog where you can find more educational resources like this one. Lastly, make sure to follow me on TikTok at Coffee Hour with Jose. I'll see you next time.